We recently had a new client come in, and I thought it'd be a good opportunity to talk about their portfolio as it relates to what our client portfolios look like, as it is a good typical representation of what a near retiree portfolio looks like and what we would do to transition from that portfolio to our portfolio. So a little bit background on who these clients are, because I think it's relevant to get an idea of why they bought what they did and why we are going to transition into what we would normally do. So they are nearing retirement. They're a few years out. The wife worked as a federal contractor, so she was able to participate in the TSP plan. The husband worked for a tech company, and they work with the financial advisor here in town, and I believe it's an LPL financial advisor. So they're nearing retirement. Their big question is, can I retire? How do I retire? How do I withdraw from this portfolio? How do I be tax efficient? And how do I sort of structure all these moving parts of my life so that they can help us achieve our big life goals? So the total portfolio is about $2.6 million, and that's broken into several different accounts, obviously. The wife's thrift savings plan, the TSP plan, is about $550,000, and all of it is within the C fund. So if you're not familiar with the TSP account, the TSP is basically the federal government's version of the 401k, and pretty much all of the rules, the same rules apply with some nuances, but it's a way for federal employees to defer their income just like any other worker would within their own 401k or 403b account. The TSP is pretty unique because there's only 5 individual funds available to them across the board. And so the C fund, which is called the common stock fund, is the S&P 500 fund. So it's an index fund. And the wife here in this case, Maya, as we're going to call her, we changed their names obviously. Maya has put in all of it within the C fund, which for the past decade or so has done extraordinarily well. So this account has done pretty good. With their advisor, they have 2 accounts there. They have a joint tenant account. $850,000 is within that joint tenant account, and all of it is within American funds. So this particular advisor seems to really like American funds. All of it is within A-share American funds, which we'll go into a little bit deeper, but real high level. A-shares are front-loaded funds. So whenever you're looking at mutual funds, there's generally 4 different classes of mutual funds. You have A-shares, B-shares, C-shares, and institutional. And the difference between all of them is the fee structure. A-shares are front-loaded, meaning that whenever a financial advisor were to buy these A-shares for their clients, there's a really big commission up front. And the commissions for these funds are about 5.75%, which is really high. But those fees have already been had. There's nothing we can really do about it. So there's an ongoing maintenance fee thereafter. So the clients are paying that. They also have an IRA under the husband's name of about $430,000, and all of it is within a floating rate ETF. The ticker is FLOT. The reason why, as the husband explained to me, is because he is very worried about the economy. He feels like the stock market is overvalued, the economy is slowing down, there's a lot of geopolitical risks out there, and so he didn't want to expose that money because that is his retirement money, and so he wanted to wait for a better buying opportunity to buy in. A classic mistake. We'll talk a little bit more about that. They have about $236,000 in a Schwab account where they bought 3 stocks a while ago and they've held on to it and they don't know really what to do with it. And those 3 stocks are Tesla, which is about $60,000. They have Meta, which is Facebook, of about $120,000 in that stock. And they have Qualcomm, about $56,000. And the last major investable asset that they have is a savings account that they have with about $600,000. Again, they're worried. They don't really know what to do with this account, especially as they approach retirement. So they didn't fully trust the advisor that they're with currently. And so they just kind of left that off to the side, looking for better guidance in terms of how to allocate that capital towards their goals. Okay, so what I wanted to do is show you exactly what a typical portfolio would be for our clients. So this is not exactly what we buy for our clients. What I wanted to do is kind of create a representative portfolio. Think of this as a simplified version of a moderate aggressive portfolio of what we would do for our clients. So it's kind of a simplified, slimmed down, all Vanguard ETF portfolio. We don't use all Vanguard. We're not tied to just one specific fund manager or fund company, but I chose Vanguard because Vanguard is very well known. You can buy it just about anywhere. Their trust level is extremely high. You know that you're getting high quality with Vanguard products, and their expense ratios are very low, very similar to our own portfolio. So I thought this would be a really good representative portfolio. So I went through, looked at what our moderate aggressive portfolio currently looks like, and created a simplified pared down version of that just to show you high level what a portfolio of this size looks like today and how it can transition into another one. So let's go through this right now. So the way that you're looking at this chart right here is you have two different columns. You have the moderate aggressive portfolio, which is what we want this client to be in, versus what they're currently in. So I just labeled that a $2.6 million portfolio. And you have the weights of all these different positions all the way down here. So the columns here on the left is what they should be in, or what we're recommending that they do. And then the column here on the right is what they're currently in. Now, you'll notice that if you start looking through all these different names, you're not going to see the C fund within the TSP. And that's because you can't just go out and buy the C fund as a regular layperson. You have to be participating in the TSP to buy the C fund. But it is an S&P 500 fund, so I used VOO right here as just sort of a substitute for it because they essentially do the same thing and their cost structure is very similar. So right now, as you can see, we have about 600 in cash, and then we have that floating rate fund over here of about 430,000. And then we have all these different American funds down here as well, including the individual stocks that they have in their Schwab account. And you'll notice that the totals equal the same. Now let's dig in between these two portfolios, and I wanted to highlight some of the things that I would quickly notice whenever I would evaluate a portfolio like this. So first off, let's look at what are the largest positions within this portfolio. So remember, whenever you buy a fund, you're buying a fund that has a bunch of securities inside of it, whether it be stocks or bonds. Most of the positions that they have are stock funds, so it's going to highlight what are the top holdings for this client here. Number one is Meta, Facebook. It represents 5.5% of their total portfolio, right? Not just of their stock portfolio or of just one account, but their total 2.6 million liquid investable portfolio. That is not abnormally large, but it is pretty large. 5% is really large. And then from there, you have 3% in Microsoft, 2.89% in Tesla, so nothing really egregious here. But I would be a little bit worried with this Meta position, because if something were to happen to Facebook and that stock were to nosedive about, call it 30-40%, that would have an impact within their portfolio. So sometimes whenever we do analysis like this, you'll see one where it'll be like 15%, 20%, because they have such a large concentrated position. And usually that'll be with a really low cost basis. And so the question is, how do we get rid of that? How do we reduce that risk? And so that's another video. That's a very deep conversation, and it really is dependent upon their own personal tax situation. But 5.5% for Meta is still pretty high. Okay, so this next section here, this is going to be talking about how is their assets allocated between stocks and bonds, namely like large cap, mid cap, small cap, things like that. So you can see they have about 41% allocated to US large cap compared to what we would do, which is about 36%. So a little bit higher, but not egregious. Mid cap is underweight with only 10%, and small cap, in our opinion, is very underweight with only 2%. Now, our firm is a little bit different. We tend to tilt towards small cap stocks, primarily small cap value stocks. We follow the data. The data says that small cap value stocks tend to outperform large cap stocks over the long run. And we believe in today's environment, it's particularly set up that way. So we are definitely overweight small caps by about 11%. So our recommendation to this client is you need to have more small cap, primarily more small cap value exposure here. There are also very underweight international stocks. We recommend about a 20% non-US stock allocation for this client, where they only have about 7%. Now, if you're watching this video, your immediate reaction is probably, no, I don't want any international exposure. Europe, Japan, China, like these are all terrible performers over the past 10, 15 years. I would say that you are right. The US stock market has outperformed international over the past 10 to 15 years, and that's pretty well documented. But the question is the US going to continue to outperform international over the next decade? Okay, so let's take a look at their bond portfolio. So they are underweight bonds. We tend to only buy investment grade bonds because bonds are supposed to be that security blanket within your portfolio. So if the economy does really poorly and the stock market were to decline, you want those high quality investment grade bonds to act as a counterweight to your stock portfolio, right? That's the whole purpose of it within a portfolio. Not every advisor or money manager agrees. Some like to buy it for yield or some like to buy it for growth. But if you're looking for growth, there's better asset classes, in my opinion, than bonds. So if you are going to be having a bond allocation, it should be a very size specific position and it should do its job. So for a moderate aggressive portfolio, you should be having about 15 to 20% of that portfolio within bonds. And of those bonds, they should be high quality bonds. So that's what this portfolio is here. So I believe that they're underweight here. They also have a lot of non-US bonds of about 8.5%, which we don't agree with. Again, we want you to buy quality. That doesn't mean that the US is the only quality issuer of bonds, but I would argue that it's probably the highest quality. So I would definitely not put too much money within non-US bonds, especially in an environment like this. And then the last piece here that really stands out to me is just a large amount of cash. They have 25% in cash. If you recall, they had about $600,000 just sitting on the sideline in cash because they didn't know what to do with it. They're at least aware that they should be allocating that capital somehow. So just to recap, we recommend about 85% stocks. They only have about 60% in stocks. We recommend about 15% in bonds. They're close, but just not the right kind of bonds. And of course, they just have too much sitting on the sideline here. Real high level of how are they invested within the different sectors here. What really stands out to me is this 27% in tech stocks. So remember, they had all those American fund mutual funds that they had. Those have large cap tech stocks. They also have the C fund within the TSP account. That's the S&P 500. The S&P 500 is about 25% tech stocks right now. So that's contributing to this 27% number here. And then of course they own those individual names, Meta, Tesla. And so those tech stocks are all just weighing really big on this portfolio. Now, it's probably done very well for them, especially recently, but don't let that recency bias drive your decision making going forward, right? Just because what worked over the past decade doesn't mean that's what's going to continue to work over for the next decade here, which leads me to my next point over here. So if you've never seen one of these boxes before, so look, you have the green box here, which is what we're recommending versus the blue box, which is what they currently have. This is just what we call like a Morningstar style box. So it's a nice way to just show you where is your stock portfolio allocated and how is it allocated. So as you can see, these are all percentages. They have 48% of their stocks all within this one box, which is large growth, which is what we just talked about, right? The C fund, the individual tech stocks that they have, that is a big risk in our opinion. Large growth has done extremely well for the 2010 decade up until about this past year, really, because it was a very low interest rate environment and a falling inflationary environment. Large growth notably did not do well during 2022 whenever we had that pullback. That's when inflation was rising and rates were rising. It also did not do too well during the 2000 era. So this is what we call the lost decade. So the lost decade means that if you were invested in the S&P 500 at January 1st, 2000, and you were to hold on to it through December 31st, 2009, you would have had a negative return for your investment. And I think a lot of people forget that. And the reason why is because we were in an era with not great growth, right? We had 2 recessions in that environment. And so people tend to look at it and say, that was the lost decade. You would not have made any money in the stock market during that decade. That's not true. Small cap and value companies, especially small value, did really, really well. So just a reminder that we think that we're in an environment where valuations are very high, large growth stocks look pretty frothy, whereas small value is undervalued. So we think that that's an opportunity here. So what we're recommending here is kind of taking some of that risk off, move it over more towards the value side of things, right over here, and then put some more money into small value, smaller companies where the opportunities do lie. So I touched upon this a little bit already. How is this portfolio allocated throughout the world? They're about 90% US. We think we should take a little bit of that risk off the table just because large cap stocks, S&P 500 has just had such a great run. Its valuation is pretty frothy. So maybe take a little bit of that risk off and then allocate it elsewhere. Notably, whenever we do invest in emerging markets, just as a side note about our firm, we do not invest in any Chinese or Russian stocks at all. We actively cut that out of our emerging market portfolio. But in this recommended portfolio, it's not representative of that because we're only just doing regular Vanguard index ETFs here. Okay, so I talked about this just a little bit earlier about the bond analysis where we recommend just high quality investment grade bonds. So that's representative here. The average credit quality of us is going to be AA. For their current portfolio, it's only single A. So we would want to upgrade the quality of those bonds as well. Okay, and so for this page right here, everybody loves this page. This is breaking down the expenses of these 2 different portfolios. So the portfolio that we are recommending here has a net expense ratio of 4 basis points, so 0.04%. What that means is the average dollar amount that you would pay to have a portfolio like this, you wouldn't actually see these fees, but they're embedded within the funds themselves, is about $1,152. Now, if you go down here and you look at these ones, what they're currently paying, their average expense ratio is 0.26, but that's within their total portfolio. That includes that cash balance, that includes everything, right? The C fund. And so if you were to look at it just within the portfolio, that's about 38 basis points, so much higher. Now, if you were to look at that sales load, whenever I was mentioning earlier the difference between A share, B share, C share, and institutional, so these are all A share American fund mutual funds, and they come with a sales load up front. So this shows you what that fee is. So whenever you were to buy these funds, whether it's through an advisor or you were to buy it yourself on your own, you're going to be paying 5.75% up front, which is crazy, especially in 2024, whenever we have so much access to all the different financial products out there. But they paid it, right? So they paid it up front. Now, the ongoing fee is what's called the expense ratio. That's sort of that maintenance fee. That's what these are line item by line item. And these numbers are still really high, even after paying this initial sales up front. So this client was completely unaware of these fees. They knew that they were paying some fees, but they didn't understand what these embedded fees within these mutual funds were on top of the advisory fee. So they're just getting crushed with fees and they don't even know it. All in all, they're paying about $7,000 per year, not including these upfront fees, just for this portfolio. And that's not even including that unallocated cash balance. So yeah, pretty high fees. They can definitely save on the fees and get a higher quality portfolio. So if you are going to manage your portfolio yourself, I think it's very important to have a very pragmatic viewpoint. So you got to be very honest with yourself. Are you managing your portfolio to the best ability that it can be managed? Are you taking an outside viewpoint of your own portfolio and looking at any different biases that you might have, like any recency bias or any emotional attachment that you may have to a stock or a fund that's preventing you from making the right decision within your portfolio? And also ask yourself, do you have the right amount of time and the right amount of expertise to manage this portfolio yourself? If you do, that's great, right? But if you don't, then you should seek out a professional. My firm, Bull Oak, what we do is we're a fiduciary advisory firm, so we don't collect commissions or we don't get paid by different fund companies for recommending American funds or anything like that. And so we are only paid directly by our clients. Our position is we only work with high-income individuals that can truly benefit from our help. So if you like this content and you want to see more content like this, be sure to hit like and subscribe on our channel. And we do send out an episode every Saturday, providing more information and data like this.